Welcome to this special coverage of ET Now, wherein be it the resurgence in the defense spending, the evolution of a global supply chain, or the AI-driven boom in data infrastructure, the industrial world is at the inflection point. And no better person to decode it all than Benjamin Heelan, who's the co-head of developed EMEA Aerospace, Defense and Capital Goods Research at BofA Securities, joining us on the show. He's joining us exclusively from the Bank of America's conference. Benjamin, great to have you on the show, and thank you so much for our time. Lots to talk about, Benjamin, but firstly, let me touch upon the defense pack, because defense is clearly a space that's seeing renewed policy focus globally, especially in Europe, where we are witnessing a scale up in the spending after years of stagnation. For the EMEA region, Benjamin, what kind of investment trajectory are you penciling in? How long and sustainable is this growth runway?
Yeah, thank you, and good afternoon, everyone. Thanks for having me. I think what you're seeing in Europe, right, is for the past 2 to 3 years since the invasion of Ukraine, we've been rebuilding our defences. We've realised that Europe needs to be able to step up and provide support to Ukraine. But I think what's caused the sector over the last 6 months to go particularly parabolic is that Europe has woken up to the fact that we're entering a decade of hard power, right? Europe as a region has historically relied very heavily on soft power, and as a result, we've just allowed our defence industrial base to get to a very, very depleted level, whether that be around operational readiness, whether that be around inventory. And I think the real trigger that we had here in Europe was not being invited to the peace negotiations, those initial peace negotiations between the US and Russia about Ukraine. And it was that event, that realization, that we just weren't being taken seriously as a threat or a negotiating power. And so what we've seen since is most countries in Europe now stepping up, announcing much higher levels of defence spending. That's going to culminate at the end of June. So at the end of June, we have the NATO Leaders Summit, which is going to be at The Hague in Europe, so the last week in June. And what I think we will see there, we will see the NATO alliance announce 3.5% of GDP as a target for defence spending, plus 1.5% on defence-related items, whether that be cybersecurity, whether that be infrastructure. So to just put that into numbers for you, right, versus the end of 2024, we think that could be an extra $370 billion of investment in Europe if we go to 3%, and obviously higher if we go to 3.5%. The second thing to remember is that we are having to spend more of that defence spending on equipment. So to give you some numbers around Germany, so Germany spent roughly 8 to 9 billion euros on actual equipment in 2021. We think that could be 60 billion euros by the end of this decade. So I hope those numbers give you some idea about the 10-year trajectory of growth that we see in Europe. So yes, we do see it as a very structural end market, particularly in Europe, but I think globally we are entering a decade of hard power investment.
Interesting point there, Benjamin. But Benjamin, let's talk about the aerospace now, because that's a sector at an intersection of technology, mobility, and then there's global trade as well. Help us understand what are the key trends that you are tracking within this sector, and is the post-COVID recovery still intact or showing some fatigue?
Yeah, so in the commercial aerospace sector, the demand environment is pretty healthy, right? People want to travel, whether that be in Europe, whether that be in America, and also, countries like India and China, where the growth is obviously far more significant than what we have in my home country of the UK. But the travel demand is clearly there. What we've struggled with coming out of COVID has been the supply chain. The supply chain has been 9 out of 10 questions that I've had to deal with over the past 3 to 4 years. How are things performing? How are we recovering from the pandemic? I think we're actually at a point now where the supply chain performance is pretty good. Things are generally being delivered on time. There are a number of little idiosyncratic items that are still delayed, weighing on deliveries in certain areas. But generally speaking, the sector's in a very, very healthy position. What we have seen year to date is we have seen kind of more macroeconomics impacting the sector, whether that be through tariffs, whether that be through licenses being revoked. Obviously, last week, the US revoked the licenses of CFM LEAP 1C engines into China. Airbus, company that I cover, is having to pay tariffs exporting equipment into their facilities from Europe into the US. And so actually it's tariffs and licensing and national security that has become the big talking point of the commercial aerospace industry. But from a cycle perspective, supply chain is good, demand is good. The outlook for that sector is very, very positive.
Right, but Benjamin, a lot of these emerging countries, or rather the developed countries, are now looking at manufacturing setup as well when it comes to the aerospace. Share your thoughts on that as well.
Yeah, look, I think, manufacturing and having your own industrial base is very, very important to a lot of countries, right? And I think that we will see a lot more of the asset base growing in a country like India, as example. Companies that I cover in Europe are obviously working with India in terms of building up facilities right now. There's been announcements from Airbus in particular around helicopter manufacturing, and I think that is a trend that you will see continue, right? If there is a significant market opportunity, if the growth is significant, then companies will clearly be looking to add capacity into the country. I think it will take time before you get large-scale aircraft manufacturing here in India. I think that's not something that is on the kind of 5 to 10 year horizon right now, at least with the companies that I cover. But yes, I think we're definitely seeing a lot more focus around India and Asia as a region, and obviously the countries in Asia want the equipment to be built in their own countries. I think we'll see those trends continue.
Interesting point there, Benjamin. But from those traditional sectors of aerospace and defense, which still continue to show signs of growth, let's talk about the emerging one. And data center is emerging out to be a major theme, Benjamin, both in terms of the power demand and capex cycle. What are you seeing in terms of the equipment demand for the data centers, and how are the capital good companies positioning themselves to ride this wave?
Yeah, I think it's obviously been a massive theme, right, over the past 2 to 3 years. The level of growth that we've seen from data centers driven by AI and the hyperscalers, particularly in North America, has been exceptional, right? We had some companies that me and my team cover growing 70% in Q1, right? And that comes from the whole stack of people providing server equipment to medium voltage electronic equipment to low voltage equipment. So I think that theme is going to continue to be very, very robust. You talked about power as well, and that is a massive theme that we're dealing with at the moment. And that comes around two areas. That's both grid investment, so building a grid that has the stability to be able to deliver the power that is required, but also manage the variability that you get as more renewable equipment and renewable energy sources are put into the grid. So we see very, very significant growth, very, very strong pricing power, given a very, very tight supply and demand market on the grid side of things. We're also seeing a resurgence in gas. Now, gas power was not an area of significant investment over the past kind of 10 to 15 years. The last real gas cycle was in the 2004 to 2006 kind of era. But now we're seeing gas coming back because a lot of the older technologies need to be replaced. Renewable power hasn't stepped up in terms of capacity additions as expected. And so you're seeing a lot more reliance now on gas. So we think we're entering a real gas cycle in terms of growth, and that will probably continue for at least through to the end of this decade. So two things I would highlight there, supporting that AI data center investment cycle is those grid investments and the gas power cycle that we're seeing.
All right, now let's touch upon the AI boom, Benjamin, because that's another key theme that everybody is talking about. Help us understand, how is the rise of the AI and automation rather reshaping the capital good industry, particularly in terms of the product innovation and the supply chain efficiencies?
Yeah, so look, our companies provide automation solutions into supply chains, right? Whether that be automotive, whether that be aerospace. And I think that automation has been a significant theme for the last 10 years. We've been coming through a bit of a destocking cycle because of COVID. We had a massive boom, and we've had to see a lot of destocking, particularly on some of the automation equipment. We think that we're largely through the worst of that now, and I think that if you're deploying capex in terms of product cycles over the next 5 to 10 years, automation is obviously going to be core to the capex build out of a lot of industries, right? So we do believe that automation is going to continue to see above industrial production growth, and is going to remain through the cycle a really attractive structural end market. In terms of artificial intelligence and the implication for our companies, we're not seeing a huge amount actually at the moment in terms of what our companies are benefiting from. That's going to be, I think, a longer term as companies are able to roll out artificial intelligence through their own companies. But there's a lot going on, particularly in the software space, whether it be around things like machine vision, again, improving the quality and the autonomy of the automation that we're putting in to supply chain. So yeah, we're going to see it, I think, in the capital goods space, much more on the equipment and the automation side.
All right, but Benjamin, with respect to the EMEA's industrial strategy, we did touch upon a couple of those sectors where the investment cycle is expected to bode well, at least in the near to medium term. But is this reshoring and nearshoring theme still a dominant narrative in the EMEA industrial strategy and will stay here for some time? What are your thoughts on that?
Yeah, I think reshoring feeds into the same debate that we were having a couple of minutes ago around defense, and we're entering a decade of sovereignty. Companies, governments, countries, the people are going to want sovereignty over their own equipment, whether that be manufacturing gas turbines, whether that be manufacturing wind turbines or grid equipment or defense equipment, right? I think that the reshoring debate is very live. It is going to drive significant capex growth. As an example, in Germany, they've announced this 500 billion euro investment package over the next decade. That is all about driving capex investment into the German economy, and reshoring is going to be a significant component of that. So yes, I think it all, whether it's reshoring, whether it's energy security, whether it's defense and the growth and reindustrializing your defense asset base, it all comes back to this theme of sovereignty, which is, I think, a theme that we're going to see continue to be dominant in markets, in particular in Europe, for the next decade. So I think when you think about the energy mix in countries, where is that energy equipment being manufactured? How are you protecting that energy equipment? I think we will see a big focus on having that done nationally rather than globally. So I do think we'll see a significant focus on reshoring and sovereignty, as I put it, continue.
With such heightened focus on defense specifically, how are the valuations stacking up looking across your coverage? I know that we can't talk stocks, but the sector-wise, because a lot of optimism has already been built in, at least when we look at the stock price momentum. But do you believe that a lot is much already in the price, or do you believe that there's a long stretch that the investors should look at?
So valuations have obviously moved aggressively, right? I think the average performance of the stocks under my coverage this year has been more than 100%. I think it's roughly 140% in the defense space, right? And obviously that level of performance does not continue every single year, right? So we have priced in a lot up front. I think the reason we've priced it in is because the market has woken up to this being such a structural change in narrative from both the government perspective and obviously the outlook in terms of growth for procurement spending. Now, in terms of valuations, we've historically looked at valuations for the defense sector relative to the market. You are trading at all-time highs on a 12-month forward basis now relative to the market, but I don't think that's necessarily the right thing to be looking at because of the duration of growth. You know, I have some companies now that are telling me they think they can grow for 20 years, 25 years, right? And so when you look at certain companies that have defense electronics, high intellectual property, whether that be around radars or communication systems or missiles, the duration of growth that I think we're going to see is going to be 10 years plus. And so actually looking out a little further than just the next 12 months, I think is a more appropriate thing. So most of our price objectives are derived by looking at growth at the end of the decade, assuming that we continue to grow into the 2030s, but that growth rate will slow. We think that that is a more appropriate measure of valuing the sector right now. And I think for a number of the companies that we cover, there is still a degree of upside. So I think to your question, we have priced a lot in. That's because of the speed and aggression with which European leaders and nations have realized the need to go and reinvest in defense. But actually, we do still think that there are some attractive opportunities from an evaluation perspective over the next couple of years.
All right, Benjamin, with this, we let you go on that note. So good having you on the show today. Thank you so much for your time.